Welcome to another episode of Get Rich Slowly, the podcast where we dive into the timeless art of building wealth through patience, smart decisions, and a healthy dose of realism in the markets. Today we're unpacking something that's been turning heads in the crypto and investment world, Tom Lee's take on the alchemy of the 5%. Yeah, that's right. It's a strategy he's been championing through Bitmine immersion technologies, and it's all about turning the power of Ethereum into a slow-burn gold mine for long-term holders. If you're tired of the hype cycles and get-rich-quick schemes that leave you burned, stick around. We're going to break this down step by step. No fluff, just the facts and the vision behind why this could be one of the biggest macro plays of the next decade or two. Let's start at the beginning because in investing, context is everything. Tom Lee has spent over 2 decades on Wall Street, from JP Morgan to his time building Fundstrat Global Advisors, where they've been calling market turns and spotting opportunities before they hit the mainstream. Tom's always been a bull on innovation, whether it's the tech boom of the 90s or the rise of Bitcoin in its early days. But Ethereum, that's where the real alchemy happens. It's not just digital money, it's the backbone of a new financial system, and the alchemy of the 5% is the blueprint for how corporations and savvy investors can tap into that by methodically building a stake in ETH's total supply. So what exactly is this alchemy of the 5%? Picture this. Ethereum has a fixed supply of about 120 million tokens. That's it. No infinite printing like fiat currencies. Now, imagine a public company deciding not to chase short-term trades or meme coins, but instead committing to owning 5% of that entire supply. That's 6 million ETH. At current prices, let's say around $4,500 per ETH, as we're recording this in mid-October 2025, that's a treasury north of $27 billion. But it's not about the dollar figure today. It's about the compounding magic that unfolds over years. We stake those tokens, earning 4 to 5% annual yields from the network's proof-of-stake mechanism. That's real yield, folks, not the phony interest rates from central banks that evaporate with inflation. It's like having a perpetual motion machine for wealth, slowly transmuting ETH into more ETH, and in the process positioning yourself at the heart of blockchain's explosion. Why 5%? It's ambitious but achievable. And here's the alchemical part. That level of ownership isn't just a number, it's a signal. It tells the market you're all in on Ethereum's future as the settlement layer for everything from tokenized real-world assets to AI-driven smart contracts. We're talking Wall Street firms staking billions, DeFi protocols scaling to trillions in value locked, and even governments experimenting with blockchain for everything from supply chains to digital identities. By holding 5%, a company like Bitmine doesn't just participate, it becomes a cornerstone, influencing liquidity, earning outsized rewards, and riding the supercycle wave that could push ETH to $10,000, $20,000, or even higher in the coming years. Tom Lee has modeled this out. Matching Ethereum's network value to Bitcoin's gets him to $60,000 per ETH in 5 years. It could be said that this sounds like Michael Saylor's Bitcoin playbook with MicroStrategy, or strategy, as they're calling it now. And that would not be wrong. Saylor's been a genius at leveraging debt and equity to stack SATS, turning a software company into the world's largest BTC holder. You've got to have mad respect for that. It's bold. It's conviction investing at its finest. But Ethereum's different. Bitcoin's the digital gold, the store of value. ETH is the digital oil, powering the entire machine. It's got utility baked in. The ERC20 standard alone has birthed thousands of tokens, NFTs, and dApps. And with upgrades like Denkern and Prague rolling out, transaction costs are plummeting, scalability is soaring, and Layer 2 solutions are making it feel like Visa on steroids. The alchemy of the 5% is ETH's answer to Saylor's strategy. A corporate treasury that's not static but generative, producing yields while the asset appreciates. And here's a real-world peek under the hood. Back in July 2025, Tom Lee launched this vision at Bitmine with an investor presentation titled, fittingly, The Alchemy of 5%. It wasn't some pie-in-the-sky white paper, it was a roadmap. He started small. Well, small for him, buying dips and staking immediately. By August, there had been amassed 1.87 million ETH. worth about $8.3 billion at the time, plus some BTC for diversification and cash reserves. That's already over 1.5% of the supply. Fast forward to September, they had raised $365 million in a stock offering at a premium, $70 a share, 14% above market, because institutions like ARK Invest, Founders Fund, and Pantera saw the vision. They get it. This isn't gambling. It's engineering exposure to the biggest tech financial fusion since the internet went mainstream. And just last week, as of October 13th, they crossed a milestone that's got the crypto world buzzing. After a nasty liquidation wave hit the markets, ETH dipping below $4,000, they pounced, bought 202,037 ETH on the cheap, pushing their holdings past 3 million tokens. That's 2.5% of the total supply, folks, over halfway to the goal. They're the largest ETH holder globally, second only to Strategy in overall crypto treasuries. Staking rewards, they're compounding at 4.5% APR right now, adding tens of thousands of ETH annually without lifting a finger. Now, the Alchemy isn't just about stacking coins, it's about the macro forces converging to make ETH indispensable. Think back to 1971, when Nixon shocked the world by closing the gold window. Overnight, the US ditched the gold standard, unleashing Wall Street's creativity. No more shackles. Suddenly, you had eurodollars, derivatives, junk bonds, and the birth of modern finance. Trillions poured in, turning banks into behemoths. Fast forward to today, crypto's doing the same for blockchain. The SEC's Project Crypto and the Genius Act in 2025 are like that gold window moment. They're clarifying rules, green-lighting ETFs, and inviting institutions to the party. Spot ETH ETFS are live, pulling in billions monthly. BlackRock, Fidelity, they're not just dipping toes, they're diving headfirst. Layer on AI, and it gets explosive. AI needs data, compute, and trustless execution. Ethereum's the perfect canvas. Tokenize AI models, create decentralized compute markets, settle micropayments for inference in real time. Imagine NVIDIA's GPUs, but on-chain with smart contracts ensuring fair pay for every joule of energy. Or real-world assets, RWAS, as we call them. BlackRock's already tokenizing treasuries on Ethereum. Soon it'll be real estate, art, even carbon credits. The total addressable market? Quadrillions, and Ethereum captures 70% of that activity today. This isn't a bubble, it's a transformation. The supercycle Lee sees unfolding is 10 to 15 years of steady adoption, not moonshots and crashes. Sure, volatility's part of it. We buy those dips. But the trend is inexorably up. Crypto is young. Regulations could tighten, tech risks like quantum threats loom distant but real, competition from Solana or Layer 1s, they're fast, but Ethereum's the incumbent with the deepest liquidity and developer mindshare, over 4,000 monthly active devs, double anyone else, and staking? It's secure, but slashing penalties keep us honest. At BitMine, they're diversified. 95% ETH, but with BTC hedges and cash for opportunities. Leverage, minimal. They issue equity when shares trade at premiums, not debt that bites back in downturns. The key is patience. If you're an individual investor, you can't replicate a corporate treasury, but you can mimic the spirit. Dollar cost into ETHETFS weekly, stake via platforms like Lido or Coinbase, and hold through the noise. Aim for your own mini Alchemy, maybe 5% of your portfolio in ETH, compounding slowly. We've got proof points stacking up. Since launching in June, BitMine stock is up over 1,000%, not because of hype, but because the market sees the flywheel. Buy ETH, stake for yield, issue shares backed by appreciating assets, repeat. Institutions are piling in. Galaxy Digital, Kraken Ventures, even Bill Miller's on board, and Tom's monthly Chairman's Message series. It's blowing up on YouTube, breaking down charts, policy shifts, and why ETH, the trade of the decade. If you haven't checked it, do it. It's free education on turning complexity into conviction. As we wrap this up, and trust me, we've only scratched the surface here, remember the ethos of get rich slowly. The alchemy of the 5% isn't a sprint, it's a marathon of conviction. It's believing that in a world of fiat debasement and tech disruption, owning a slice of the most programmable asset on the planet is the ultimate hedge and accelerator. Whether you're a retiree building a nest egg or a fund manager reallocating, start small, stay consistent, and let compounding work its magic. Ethereum's not just money, it's the future of money, and 5% is your golden ticket. Thanks for joining me today on Get Rich Slowly. If this sparked something, Hit that subscribe button, drop a comment on what macro play you'd like next, and I'll see you in the next episode. Stay patient, stay invested. Wealth builds one steady step at a time.